Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It is great to be back, and today we have got a massive topic to chew on.
We really do. You know, usually when I see a headline about a high-level diplomatic phone call, my brain just instinctively shuts off.
Right, it sounds boring.
It sounds so boring. It's just formal handshakes and press releases that say nothing. You know, a lot of frank exchanges of views, which is just code for we yelled at each other.
Exactly.
But yesterday, February 4th, 2026, that felt different.
It was different.
We had President Trump on the line with Chinese President Xi Jinping, and the thing that caught my eye wasn't the politics, it was the tickers. The markets actually moved. They woke up.
They did, and for good reason.
Yeah.
You have to remember, in our world, silence between superpowers is terrifying.
Right.
Silence breeds uncertainty, and markets hate uncertainty more than anything else.
Right.
But communication, even if it's tense, even if it's guarded, it lets the market breathe. That sigh of relief is exactly what we saw.
So that's our mission for this deep dive. We're going to peel back the layers of this call. We need to figure out what was actually said, what was just, political fluff, and most importantly, what this all means for your portfolio.
And based on the research we've pulled from Reuters, the Washington Post, the Financial Times, there's a lot of signal hidden in the noise.
We're going to decode this thing.
And to do that right, we have to start with a vibe check, because if you read the reports from Washington and then the reports from Beijing, you'd think two completely different phone calls took place.
I noticed that too. I was scrolling through Truth Social to see President Trump's take. He didn't mince words. He called the conversation long and thorough and even excellent.
The glowing review.
Totally. And he dropped a little teaser about a visit to Beijing in April. It sounded like a victory lap. Very much, I've got this handled. Relationships are good.
That was the American executive summary, absolutely. A triumph of personal diplomacy. But let's look at the Chinese side of the ledger.
Yeah, the reporting from the Washington Post on Beijing's take felt colder?
It really was. There was no talk of a warm reunion or being best friends. The key word coming out of Beijing was guardrails.
Guardrails, like on a highway.
Exactly. The Chinese message was incredibly cautious. They weren't talking about driving off into the sunset together. They were talking about preventing a crash.
That is a huge distinction.
Yep.
So on one side, you have excellent conversation, and on the other, it's let's just try not to drive off a cliff.
A very big difference.
It reminds me of a couple that's been on the verge of a messy divorce, and they agree to go out to dinner.
Okay.
They agree to be civil, maybe talk about the weather, just to keep the peace. But it doesn't mean they've solved any of the deep underlying arguments.
That is a spot-on analogy.
Yeah.
And think about that couple at dinner. What do they talk about first?
The easy stuff.
They start with the appetizer.
Yeah.
Things that are easy to agree on.
The safe subjects.
Mm-hmm.
Which brings us right to our first segment, easy wins. This is the fun part for the markets. This is what made the screens turn green.
The meat of the deal, or maybe the protein of the deal.
Soybeans. I never thought I'd be so excited about legumes, but here we are. According to Reuters, Trump mentioned that China is considering increasing purchases of U.S. soybeans, and the numbers are huge.
We're not talking small potatoes here.
No, we're talking about a jump from the current 12 million tons to 20 million tons.
And potentially 25 million next season.
Right. And you could see the reaction immediately on the Chicago Board of Trade.
Mm-hmm.
For anyone listening who doesn't watch crop futures, that's basically the world's marketplace for this stuff.
Well, when that news hit, prices jumped. It's tangible. It's not just talk. It's tonnage.
But help me out here. Why soybeans? Is it just about the money?
Money is part of it, sure, but it's also about political geography. I mean, think about who grows soybeans.
The American heartland.
It's a key constituency. A win there is politically very savvy for a U.S. president, but it's also just structurally easy. The infrastructure is there. You don't need to invent a new technology. You just sign the contract and load the boat.
It's a turnkey win, ready to go.
Precisely. And it wasn't just agriculture. The conversation also covered energy China, buying more U.S. oil and gas, and accepting deliveries of airplane engines.
So, planes, grains, and fuel.
And we have to ask why these items. Why start here?
It has to be the low-hanging fruit theory, right? Like the appetizer at that awkward dinner.
It is. The Financial Times analysis points out that these are sectors with big price tags that create immediate, visible wins for American producers. Farmers, energy companies, manufacturers.
So back to our couple. This is them agreeing to order the nachos.
Ah, exactly.
Everyone likes nachos. It's easy. It makes everyone feel happy for a moment.
Correct. These deals act as a buffer. They lower the temperature in the short term, It lets both sides go home and say, look, we are cooperating, but, and this is the crucial part, it does not solve the root causes of the conflict. It just buys time.
Okay, so we've bought some time with soybeans and nachos. But let's pivot to the hard stuff. The stuff that soybeans can't fix. The elephant in the room. Yeah. I was reading through the reports, and while they mentioned Taiwan was discussed, it felt different. There wasn't a deal there, was there?
Far from it. In fact, if you look at the language, the Chinese side maintained a very stern warning tone about U.S. arms sales to Taiwan. This is still a managed issue, not a solved one.
And this brings us to a concept that's really important for our listeners, especially newer investors. The idea of tail risk. Can you break that down for us?
Sure. Imagine a bell curve. You know, that hump shape. Most of life happens in the middle, the big fat part. That's a normal day. A tail risk is an event that is way out at the very skinny end of the curve.
So it's very unlikely to happen.
Very low probability. Most days, it won't happen. But if it does happen, the consequences are catastrophic.
Yeah.
Think of it like a house fire. The odds of your house burning down today are tiny. But if it happens...
You lose everything. That's why you have insurance.
Exactly. So applying that here, even with this excellent phone call, that house fire risk around Taiwan hasn't actually gone away.
It's still there.
It has not. The probability might have shifted a little, but the risk of sudden military drills or a blockade or an accidental collision, that is still real.
It's like driving a car and the check engine light is on. You can turn up the radio, that's the soybean deal, the happy music, and sing along so you don't hear the engine rattling. But the light is still blinking on the dashboard. The problem is still under the hood.
That is a very vivid and accurate way to put it. You can't fix a transmission problem by buying more gas. And investors need to remember that light is still blinking.
Okay, keeping that blinking light in mind, let's zoom out, because this call didn't happen in a vacuum. There's a whole game of global chess going on here.
There is. And reports from the Financial Times show that the U.S. went into this with a specific geopolitical wish list. It wasn't just about trade.
What were they looking for?
They want China to use its influence as a linchpin, primarily for Iran and the Russia-Ukraine situation.
So basically asking China to help do some of the heavy lifting on global security. Hey, you're a superpower too. Help us fix this mess.
Essentially. But the analysis suggests China is hesitant.
Why? Wouldn't stability help them too? Wars are bad for business.
Stability is good, especially for their energy imports.
Yeah.
But they aren't exactly jumping at the chance to be a co-manager of the world on America's terms. Why spend their political capital to solve an American problem?
That makes sense. You broke it, you fix it, sort of. And speaking of which, it seems Xi Jinping was multitasking.
Yes, this is a key detail.
Yeah.
Reports indicate that around this same time, literally in the same news cycle, Xi was also communicating with Vladimir Putin.
Which sends a pretty clear signal, right? I can talk to Trump on Tuesday and Putin on Wednesday.
Exactly. It signals that China isn't abandoning its other alliances just because they agreed to buy some American corn. They're keeping their options open.
Okay, so we have easy wins with soybeans, we have lingering tension over Taiwan, we have the global chess game, but then there was a plot twist.
The curveball.
Something dropped right around the time of the call that really complicates this whole happy narrative. The critical minerals trade block.
This is the story that should have been on the front page of every investor's notebook.
What is it exactly? It sounds more serious than Legos.
Much more serious. Reuters is reporting that the U.S. is proposing a new trade bloc to counter China's dominance in critical minerals. We're talking lithium, cobalt, rare earths.
The stuff that goes into everything that matters for the future.
Everything. Electric vehicles, advanced electronics, missile guidance systems, AI hardware. China has a chokehold on processing these minerals. The U.S. is trying to build a coalition to get around that.
Wait, hang on, let me get this straight. On one phone line, they're agreeing to sell billions in soybeans and oil, very 20th century stuff. And on another, the U.S. is organizing a group to cut China out of the supply chain for the most important materials of the 21st century.
That is the reality, and it defines what we call the dual-track era of U.S.-China relations.
Dual track, break that down.
It is partial cooperation combined with structural competition.
It feels contradictory. It's like... Okay, let's try another analogy. Two rival sports teams, say the Yankees and the Red Sox.
Okay, I'm with you. Historic rivals.
Right. They might agree on the rules of the league, the schedule, the strike zone, how to sell tickets. That's the soybean deal. They need the game to happen so they both make money.
Go on.
But at the exact same time, in the back office, they are aggressively recruiting against each other. They're trying to steal prospects, analyze signs, doing everything possible to make sure the other team doesn't win the championship. That's the critical minerals block.
That is a fantastic analogy. They're agreeing on the framework so the game can be played, but they are absolutely playing to win. This is what we call institutionalizing the competition.
Institutionalizing the competition.
Yes. It means the fight isn't an accident anymore. It's built into the system. The fight over tech and resources isn't a temporary spat.
Yeah.
It's becoming a permanent fixture of the global economy.
So the fight over who controls the future of tech is happening right alongside the handshake over who sells the corn.
Correct. And for you as an investor, distinguishing between those two tracks is everything. You can't just say, China relations are up, buy everything.
Okay, let's bring this home. We've unpacked the call, the geopolitics, this crazy dual track idea. But if I'm sitting at home with my 401k, just starting out, what do we do? How should I read this?
Well, let's break it down by time frame. Short term versus the long term.
All right, hit me with the short term. What happens this month?
In the short term, this is good news. Plain and simple. The risk premium, which is really just the extra fear priced into the market, has dropped.
So the market relaxes a bit.
Exactly. And for agriculture and energy stocks, this is a direct boost. We're talking about real revenue hitting the books from these deals.
Okay, so ag and energy get a green light for now. That makes sense. What about the medium to long term?
That's where you need to stay cautious. The structural competition we talked about, the Yankees versus Red Sox fight, isn't over. It's ramping up.
Because of the critical minerals block?
Yes. And the ongoing tech restrictions. If you're investing in technology, industrials, or EV supply chains, you have to be careful. The news about the mineral block suggests supply chains could still get very messy and expensive.
So just because a big tech stock might bump up on the general good mood of the market today doesn't mean its structural problems are solved for tomorrow.
Precisely. We shouldn't bet on a total relationship fix.
It sounds like the advice is don't just buy the market blindly because peace is broken out.
No. The smart money looks at specific sectors. Be granular. Who actually sells the soybeans? Who is shipping the gas? Look for the companies that benefit from the easy wins, but be very wary of the sectors caught in the crossfire.
So treat the old economy stuff corn, oil, differently than the new economy stuff like chips and minerals.
Exactly. View this phone call as a pause in the tension, not an end to it.
A pause, not an end. That's a great takeaway.
And remember, volatility creates opportunity, but only if you understand why the market is moving. If you buy the rally thinking everything's fixed, you might get burned.
Absolutely. You know, this brings up a really provocative thought for me. We're seeing this split-screen world. On one side, the U.S. and China are cooperating on old economy things. Soybeans, oil. It feels like 1990.
A bifurcation, a fork in the road.
But on the other side, they are fighting tooth and nail over the new economy. Minerals, chips, AI. So if they can agree on the old stuff but fight over the new stuff, what does that tell us about where the real value lies in the next 10 years?
That is the multi-trillion-dollar question.
Are we looking at a split global economy where you have to pick a side for your tech stack? Are you Team US or Team China for your phone? But everyone still eats the same tofu.
It's a fascinating, if slightly worrying, thought. If the world splits into two tech ecosystems, the companies that can navigate that split will be the kings of the next decade.
A lot to mull over. We might be heading into a world where your breakfast is global, but your smartphone is strictly geopolitical.
A lot to think about.
Well, that's all we have time for today on this deep dive. We hope this helped you decode the signal from the noise on that Trump Xi call.
Stay curious and keep watching those supply chains.
Don't forget to subscribe and hit that like button.